You've heard the stories about the S&P 500, the legendary wealth-making machine that has powered portfolios in the US and across the world for decades. You're ready to start investing, but when you search for it in your brokerage account, you're hit with a confusing list of tickers: VOO, IVV, SPY, SPYM. What's the difference, and how do you pick the right one? In today's episode, we're going to clear up that confusion. We'll start by explaining what the S&P 500 actually is, and then we'll decode the popular ETFs that track it. That choice can feel paralyzing, but it's simpler than you think. For most long-term investors, the difference comes down to just one crucial factor, and by the end of this video, you'll know exactly what it is, which fund to buy, and how to invest with complete confidence. Okay, before we get into decoding all those tickers, let's just make sure we're on the same page. What are we actually talking about here? First, the S&P 500. The Standard & Poor's 500 is simply a list or an index of 500 of the biggest and most important companies in the United States. When you hear on the news that the market is up, a lot of the time they're talking about the S&P 500. It's the most common benchmark for the whole US stock market. The index is broken down into 11 sectors. The most noticeable is the information technology sector, which includes giants like Microsoft, Apple, and Nvidia. But other household names are categorized elsewhere. For example, Google and Meta belong to the communication services sector, while Amazon and Tesla are main constituents of consumer discretionary. The index has a long history. Its origins trace back to 1860, when Henry Varnum Poor started a publishing company that created an investor's guide to the railroad industry. After a series of other indexes were developed, his company merged with the Standard Statistics Company in 1941 to form Standard & Poor's. Then, on March 4, 1957, the index was expanded to include 500 companies and was renamed the S&P 500, creating the market benchmark we know today. Since its launch, it has become a bedrock of wealth creation. To put its power into perspective, if you invested $100 in the S&P 500 at the beginning of 1957, you would have about $98,024.63 by the end of 2025, assuming you reinvested all dividends. This represents a return on investment of over 97,000%, or an average of 10.56% per year. Over the past 10 years, the return is even more phenomenal, offering a very solid 12.65% annualized return. Now, you can't just buy the index directly. An index is just a list. So instead, you buy a fund that's built to perfectly copy that index. And that's where an ETF, or an exchange-traded fund, comes in. Imagine it like this. Think of a shopping basket. Instead of walking through the store and buying 500 different things one by one, you can just grab a pre-made basket that already has all 500 of them inside. An S&P 500 ETF is exactly that. One single thing you can buy and sell on the stock market, just like a regular stock, that holds a piece of all 500 companies in the S&P 500. So why is this such a powerful tool, especially for beginners? Well, there are three main reasons. Instant diversification. When you buy just one share of an S&P 500 ETF, you instantly own a small piece of 500 different companies. You're not betting your entire future on just one company's success. You're spreading your risk out. If one company does poorly, it's balanced out by the other 499. This is the most important rule for safe, long-term investing. Extremely low cost. As we're about to see, these funds are incredibly cheap to own because they're passively managed, meaning there isn't a team of expensive analysts trying to pick hot stocks. The fees are microscopic. This low cost is a secret weapon for building wealth because it means more of your money stays invested and working for you. Proven historical performance. Over the long run, the S&P 500 has a fantastic track record. Sure, it has down years, but its average annual return over many decades is around 10%. By investing in an S&P 500 ETF, you're plugging into the long-term growth engine of the American economy. And this is why that's so powerful. Remember, 91.03% of actively managed U.S. large-cap equity funds underperformed the S&P 500 over the past 20 years, according to the SPIVA US Mid-Year 2025 report. This means that by simply buying an S&P 500 ETF, you are statistically positioned to outperform the vast majority of professional stock pickers over the long term. So in short, an S&P 500 ETF is a simple, diversified, low-cost way to invest in the market's long-term growth. It's the perfect starting point for pretty much any investor. All right, let's get into the main event and decode the four contenders: VOO, IVV, SPY, and SPYM. When you search for an S&P 500 ETF, you're almost always going to see these four. First on the list is SPY, the SPDR and P500 ETF Trust. Think of SPY as the original, the OG, the trailblazer. It launched way back in 1993 as the very first ETF in the US. For a long time, if you wanted to invest this way, SPY was your only choice. It's the oldest, most famous, and most heavily traded ETF in the entire world. Next up is IVV, the iShares Core S and P500 ETF. This one came out in 2000 from BlackRock, which is the world's biggest asset manager. It was a direct competitor to SPY, and it's become super popular with hundreds of billions of dollars invested in it. Then we have VOO, the Vanguard S&P 500 ETF. This one launched in 2010, and it's from Vanguard, a company famous for its low-cost investing philosophy. Even though it's younger than SPY and IVV, it's grown like crazy. And finally, there's a fourth one that's been getting more popular, especially with new investors: SPYM, the SPDR Portfolio S and P500 ETF. A quick heads up. This ETF used to be known as SPLG, but as of October 31st, 2025, it changed its name and ticker to SPYM. It was basically created by State Street, the same company that runs SPY, to be a lower-cost alternative to compete with funds like VOO and IVV. So, to recap, we have four funds from three huge companies, all built to do the exact same thing: track the S&P 500. Their performance is nearly identical because they hold the exact same stocks. So if they're all the same, why do they all exist, and how in the world do you choose? That brings us to the most important part of this video. If you only take one thing away from this whole video, let it be this. For a long-term buy and hold investor, the single most important difference between these funds is the expense ratio. What's an expense ratio? It's just a small annual fee the fund charges to cover its costs. Think of it like a tiny, tiny leak in your investment bucket. A small leak doesn't seem like a big deal day to day, but over 20, 30, or 40 years, you can lose a whole lot of water. Your goal is to find the bucket with the smallest possible leak. Let's just look at the numbers. SPY, the original, has an expense ratio of 0.0945%. IVV and VOO came along and have an expense ratio of just 0.03%. And SPYM, the newer one, has the lowest of them all at 0.02%. Now, your brain might see 0.09% and 0.03% and think, come on, that's a fraction of a penny. Who cares? And that right there is the multi-million-dollar mistake that uninformed investors make. Let's put this into actual dollars to see what I mean. This fee is charged on every dollar you have, every single year. On a $10,000 investment, SPYM at 0.02% costs you $2 a year. VOO and IVV at 0.03% cost you $3 a year. SPY at 0.0945% cost you about $9.50 a year. Again, you might be thinking, a few bucks a year? I spend more than that on coffee. But you're not going to have just $10,000 in there forever, right? You're going to keep adding to it, and it's going to grow. Let's fast forward 30 years. Let's say you invest $10,000 today and add $500 every month, getting that historical average of 10% per year. After 30 years, in the fund with the 0.0945% fee, SPY, you might have around $1.18 million. Not bad, right? But in the fund with the 0.03% fee, VOO or IVV, you'd have about $1.21 million. That's a $30,000 difference. That's a new car, a down payment, years of vacations, all gone because of a fee that looked too small to matter. The lesson here is crystal clear. Fees are a silent killer of your long-term returns. As a beginner, your main goal should be to cut down on costs. Every dollar you don't pay in fees is another dollar that stays in your account working for you. Okay, so with the huge importance of expense ratios locked in, we can make this choice really, really simple. For 99% of beginners, the long-term investor, the answer is VOO, IVV, or SPYM. If your plan is to buy and hold for the long term, and for most of you that absolutely should be the plan, your choice is simple. You should choose one of the ultra low-cost options. Vanguard S&P 500 ETF. With its 0.03% expense ratio and Vanguard's investor-first reputation, VOO is a fantastic choice. IVV iShares S&P 500 ETF. It has the exact same 0.03% expense ratio and is backed by BlackRock, the world's largest asset manager. It's an equally fantastic choice. SPYM, State Street S&P 500 ETF. At 0.02%, this one is technically the cheapest of the group and an excellent choice if you want to squeeze out every last penny. Just remember, this is the one that used to be called SPLG. Honestly, the difference between 0.02% and 0.03% is so minimal that you can't go wrong with any of these three. VOO and IVV are a bit bigger, SPYM is a bit cheaper. The best decision is to just pick one and get started. Do not let analysis paralysis over that tiny difference stop you. All three are top-tier solid options. So why does anyone buy SPY? This brings up the obvious question. If SPY is more expensive, why is it still so popular? The answer is one word: liquidity. It just means how easily you can buy or sell something without the price moving. Because SPY is the oldest and most traded, a crazy amount of shares change hands every day. To put it in perspective, SPY trades an average of around 80 million shares daily. In contrast, VOO, IVV, and SPYM typically trade somewhere between 7 and 11 million shares a day. That incredible volume makes SPY the go-to for big institutions, hedge funds, and day traders moving huge amounts of money around really fast. For them, being able to execute a massive trade instantly is more important than a slightly higher annual fee. But for you, the beginner who is planning to buy and hold for years or decades, that extreme liquidity is totally irrelevant. VOO, IVV, and SPYM are all more than liquid enough for you and me. You'll have zero problems buying or selling them. So, paying a higher fee for a benefit you don't need just doesn't make any financial sense. Just to be super thorough, there is a tiny technical difference worth mentioning, which is the fund structure. But again, these shouldn't be what you base your decision on. There's a key difference in how these funds are legally set up. SPY is structured as something called a Unit Investment Trust, or UIT. VOO and IVV are open-end funds, which is a more modern and flexible structure. But they even differ from each other. IVV is a conventional standalone ETF. It's not tied to a mutual fund and uses standard ETF creation and redemption mechanics. VOO is unique. While it trades like a normal ETF, it's legally a share class of the larger Vanguard S&P 500 Index Mutual Fund. This special structure, which Vanguard patented, allows it to combine the assets from both the ETF and the mutual fund. This can create significant tax advantages by using the mechanics of the ETF to help minimize taxable capital gains for investors in both funds. The bottom line is that the more modern structures of VOO and IVV are a bit more flexible and tax efficient for long-term holders than SPY's older UIT structure, which has stricter rules about reinvesting dividends. Once you make your choice and become an S&P 500 investor, you've secured the foundation for your entire investment portfolio. But it's important to understand where this fits into the bigger picture. While the S&P 500 is diversified across 500 companies, it does have two specific concentrations. It's 100% US companies. It's 100% large cap companies, the biggest of the big. For even better diversification, many investors will add other funds over time. For example, you might consider an international stock market ETF to get exposure to companies in Europe and Asia. Or you could add a total US stock market fund, which includes thousands of mid-size and small companies too. How much you put in stocks versus other things like bonds depends on your age and risk tolerance. But the key thing is, your S&P 500 ETF is that solid, reliable core for your strategy. You've already made the most important decision. All right, let's bring it all home. We started with that confusing alphabet soup of VOO, IVV, SPY, and SPYM. Now you know the secret. It's not that complicated. You understand that for a long-term investor, the only factor that really moves the needle is that expense ratio. You know that VOO, IVV, and SPYM are all premier, low-cost, fantastic choices that will serve you incredibly well, while SPY is a more expensive tool for high-frequency traders. Most importantly, you know exactly how to pick the right fund for you and why it matters. The biggest mistake in investing isn't picking VOO over IVV. It's being so paralyzed by minor details that you never start at all. You now have the knowledge you need to act with confidence. You've turned that confusion into clarity. The next step is taking action. The sooner you start, the more time the magic of compounding has to work for you. If this guide has helped you, please subscribe for more simple, actionable investing content designed to help you build wealth with confidence. Thank you for your time today, and congratulations on taking this huge step in your financial journey. And last but not least, this video is for education and general information only. It is not financial advice and does not consider your personal circumstances. Always do your own research or speak with a licensed financial professional before making investment decisions.